Like, when is the biggest money made? Usually in two situations. First, when a company's earnings are growing extremely fast, and second, when a stock has corrected 40-50% but the earnings and the business are growing strongly. Now that is when a stock becomes underpriced, seriously underpriced or undervalued. And during this result season, two such stocks have caught my attention. And interestingly, these are also the stocks which many of you have been asking about in the comment section. Both of them are 40-50% down from their highs and both have high quality businesses. But the question is, are they worth buying right now? Now that is the question which we are going to answer in this video. Two stocks 50% down but high quality businesses. But before we start the video, here is a quick introduction. This is Sanika Karnik, CEO and founder at RangaOne Finance. Now many of you feel that I am just the face of this channel, but that's not true. The research that you hear is personally done and reviewed by me with support from my research team. So at RangaOne Finance, we don't just make videos for views. We focus on providing real value because your growth is our priority. And now let's start with the video. Now let's start with the first stock. This company operates in the affordable housing finance space and it lends to mainly low and middle income self-employed customers in semi-urban areas. Now historically, this has been a strong compounding business. Over a period of 5 years, its asset under management compounded at 26% while profit compounded at approximately 29%. And if you look at the latest headline numbers, the business still looks strong. AUM grew 21% to over 13,600 crore rupees and disbursements jumped 36%. Net profit grew 19% to 261 crore and return on equity remained about 20%. But here's the catch. Despite this 19% profit growth, the stock fell 6% on the day the results came out. At around 250 rupees, the stock is over 30% below its 52-week high. And more importantly, it had earlier corrected nearly 46% from peak to bottom before recovering. So why did the market punish a company whose profits are still growing? Because in a lending business, today's growth can become tomorrow's bad loans. And in this quarter, the market saw early warning signs. Collection efficiency fell to 98.5%. Gross NPA increased from 1.49% in the previous quarter to 1.70%. And credit costs also nearly doubled year on year. Now this deterioration was concentrated mainly in its NBFC subsidiary. Collection efficiency in the core housing finance business was approximately 99.5%. But in the NBFC book, it was closer to 97.5%. The management says that this was a temporary late June collection issue and not a deterioration in customer quality. And according to the management, collections have improved in July and 30+ days late payments reduced by approximately 20 basis points. And stage 2 loans are also improved. Now that is encouraging, but it is still management commentary, not a full quarter of reported evidence. See, the management has retained its full year guidance of 22 to 24% AUM growth. Plus the company has also added 33 branches in this quarter and they are planning to add another 60-70 branches during the full year. Now that provides a visible growth runway, although the cost of these new branches will become visible in the coming quarters. The company that we are talking about is Aptus Value Housing Finance, and on the business quality, Aptus remains strong. And that brings us to the most important question. Is this stock worth buying at the current corrected price? See, I had recommended Aptus previously on Instagram as well as YouTube. Now our buy zone was between 249 and we were going to add more near 219 rupees. Now you can see that after we added the stock came down in a loss. Now we were at 10-15% loss at that time. But then the stock recovered and it straight went up to its resistance of 300 rupees. Now two things are important to look at for this stock. 245 to 249. Now this zone is an important support zone, and if the stock sustains over here, we can see a good reversal, and then it can be a good time to accumulate. And I have given aggressive targets for this stock around 350, and 350 is my target. And always remember, having a clear target for any stock is very important. Now for Aptus, we have shared the first target with you, and we have shared the second target with our clients. So if you also want such swing and short-term recommendations, then you can try out RangaOne Wealth Basic. Now we have intentionally kept the pricing affordable so that you can experience our research and how our updates work first. And with the basic plan, you also get access to the website and regular updates on Telegram. On the right side, you can see how continuously we are updating our clients regarding the entries, exits, targets, stop losses. And many of our clients start with RangaOne Wealth Basic and then upgrade to Premium after experiencing the quality of our research. So you can start small, test the service and upgrade only if you are satisfied. So visit RangaOne.finance today and subscribe to our plans. And yes, if you have any questions, then just WhatsApp our support team on this number. Now coming back to the stock, my view on Aptus is clear. It is not a blindly buy just because the stock has corrected. It is a watchful accumulation opportunity. In short, Aptus does not need another growth confirmation, it needs an asset quality confirmation. Now let's move on to the second stock. Now this company runs two businesses under one roof. First, it builds solar plants for other people. For example, Coal India or NTPC says, build us a 300 megawatt solar plant, and the company builds it, hands it over, takes the fees and moves on. And the money comes in relatively fast at around 16 to 18% operating margin. Second, it builds solar and wind plants for itself. And this is the important one. It spends the money, owns the plant, and then earns money from selling power for the next 25 years on a fixed contract. Think of it like real estate. In the first business, you are the contractor who is building someone else's house and taking the fees. In the second business, you are the landlord, where you are spending a lot of money upfront and then spending decades collecting the rent. So the strategy of the company is spending the contractor money to become the landlord. And the stock reached a 52-week high of approximately 542 rupees, and today it is trading near 319 rupees, a correction of approximately 41% and more than 50% down from its all-time high of 700 rupees. And just like our first stock, the headline operating numbers do not look weak. And in the latest quarter, the total income grew 16% to approximately 710 crore rupees. EBITDA grew 21% to approximately 262 crore rupees, and EBITDA margin improved. Power revenue almost doubled and power generation volume increased nearly 4 times year on year. So why did the stock crash? Because the shareholders do not get paid in megawatts, order book announcement or EBITDA headlines. They ultimately get paid through earnings per share and cash flow. And in this quarter, the profit fell approximately 18% to 86 crore rupees, and earnings per share also fell approximately 18%. So how can the revenue grow 16% and EBITDA grow 21% while the profit falls 18%? Let's find it out. See, the answer is simple. Finance cost and depreciation. The company added 45 crore at the operating level but absorbed approximately 63 crore rupees in additional interest and depreciation. Now that is why the profit before tax declined, and the management says that this is mainly a timing issue. The company has recently started many new projects. Their interest and other costs have already started, but these projects are still taking time to run at full capacity and generate full revenue. In simple words, the expenses have started first, while the full income from the new projects is yet to come. And the management plans to complete the remaining major solar and hybrid capacity by September or October. And as those projects stabilize, power revenue should increase without an equally large increase in the operating cost. Now that should help absorb the fixed interest and depreciation burden. But the recovery may not be immediate. and the management has indicated that the next quarter could remain seasonally weak due to monsoon, and it expects only a partial recovery in the second half, while the full benefit from the current plants may become visible only next year. So this makes the full year growth target heavily dependent on the execution in the remaining 3 quarters. And another important risk is promoter pledging. Approximately 45% of the promoter holding is pledged. There is also a potential dilution of roughly 5% from the outstanding warrants and employee options. And none of this means that it is a bad company. And the company that we are talking about is KPI Green Energy. And KPI Green has demonstrated genuine execution capability, and its project pipeline is credible with power purchase agreement, financing and customer contracts already signed. And its shift towards owned power assets can also improve the quality of revenue over the long term. So is KPI Green a buy after a 41% fall? See, there are 2 reasons why I am still positive about KPI Green. First is the valuation. See, when you buy a good business at a reasonable valuation, you are already creating a margin of safety for yourself. And at one point, KPI Green was trading at a valuation nearly 70 PE. And at that time, investors were still running behind the stock. And today, the valuation has come down to around 13.8 PE. So compared to its earlier valuation, the stock is really available at a much cheaper and comfortable level. Now that gives me a good cushion. Second reason is the price correction. The stock has corrected by more than 50% from its highs. Now it was once trading around 710 to 720 rupees, while my buying average is roughly 380 to 390. So both the valuation correction and price correction are working in my favor. On top of that, the company has a healthy order pipeline and is continuing to expand aggressively. But yes, I want to make one thing very clear. This is a high risk stock, and whenever I am taking a higher risk, I expect the potential reward to justify that risk. So now what is my next strategy? See, I'm not going to average blindly. So first, I want the stock to consolidate. Around 300 rupees could act as an important support zone. And if the stock stabilizes there and shows signs of reversal, then I will then wait for stronger confirmation. Now, ideally, I want to see the stock reclaim its 50 SMA and 200 SMA before adding more quantity. So this is not a stock to buy in excitement or one shot. KPI Green for me is a stock where you have to accumulate smartly and patiently. High risk but potentially high reward. So that's it for this video. I hope you liked my analysis on Aptus Value Housing and KPI Green, which was most requested by all of you. And I will see you very soon in the next video. And if you have any stocks or any sectors that you want me to analyze, then put them down in the comment section, and I will see you very soon in the next video. Till then, bye bye.
Investment in the securities market is subject to market risks. Read all the related documents carefully before investing.